The 50-year mortgage explained pros, consequences, risks, and why it can be dangerous. A 50-year mortgage is a home loan stretched out over half a century. It makes the monthly payments smaller, but it comes with significant long-term downsides that most buyers don't understand until they're already locked in. Below is the full explanation in easy everyday language, with no math and no formulas. 1. What is a 50-year mortgage? It is a loan that takes 50 years to pay off instead of the usual 30 years. The main selling point is simple: lower monthly payments so you can afford more house. But stretching the loan this far creates long-term financial consequences that outweigh the short-term benefit for most people. 2. What really happens with a 50-year loan? So A. You build very little equity for many years. In the early years of a 50-year loan, almost all of the payment goes toward interest. Your loan balance barely decreases. It can feel as if you are renting the money, not owning the home. Realistically, someone can pay for years and still feel like they owe almost the same amount they started with. B. You pay far more over the life of the loan. Even though the monthly payment is lower, the total amount you pay over time is much higher because you are paying interest for an extra 20 years. This makes a 50-year loan one of the most expensive financing options available. C. You are more vulnerable if the market drops. If home prices fall, a person with a 50-year mortgage is at higher risk of owing more than the home is worth because the balance decreases so slowly. When this happens, you may not be able to sell the home refinance move without taking a loss. A 50-year loan increases the chance of being financially trapped during a housing correction or recession. D. Refinancing becomes more difficult. A lot of people think, I'll refinance later. However, refinancing only works if the home value goes up, interest rates go down, lending rules stay flexible, you qualify based on income and credit. If any of these things shift in the wrong direction, you may not be able to refinance out of the loan. E. The debt can follow you into retirement. If someone takes a 50-year loan in their 30s or 40s, the debt can follow them into their 70s, 80s, or even 90s unless they refinance or make extra payments. This can put pressure on a retirement planning and reduce financial freedom later in life. F. Emotional impact. Feeling stuck. Many people become frustrated when they realize their balance is barely shrinking. It can feel like progress is impossible, even though they are making every payment on time. This emotional stress is a very real consequence of ultra-long mortgages. 3. Main risks and cons. You stay in debt much longer, you build equity extremely slowly, you pay much more over time, you are at higher risk if the market drops, it can interfere with retirement plans, it limits your financial flexibility later, fewer lenders offer it and terms may be stricter. It creates long-term financial stress even if the short-term payment feels helpful. 4. Investor perspective. Investors may be attracted to lower payments because it can improve monthly cash flow on paper, but the risks are serious. Equity builds very slowly, limiting future borrowing power. Refinancing becomes harder. A downturn in rents, taxes, or insurance can make the deal collapse. Selling becomes harder if the next buyer cannot get a 50-year mortgage. Investors who rely heavily on ultra-long loans create a fragile portfolio with very little room for error. 5. Final expert assessment. A 50-year mortgage may look helpful at first because of the lower payment, but it creates long-term financial risks that most buyers and many investors underestimate. It can work in rare, very strategic situations, such as an investor needing temporary payment relief, a buyer planning to pay extra every month, someone who clearly understands the risks and has a plan. But for most people, a 50-year mortgage is one of the riskiest and most expensive ways to finance a home. It slows wealth building, increases vulnerability during bad markets, and can lead to long-term financial strain.